Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, today, Mena, I would like to talk about ATO audits. It seems like the ATO is definitely on the warpath this year to much greater extent than any previous years. In fact, just over the last 2 or 3 months, we've received, or our clients have received, more audits over the last 2 or 3 months than we have over the last probably 10 to 15 years. So there's a significant change out there, and certainly over the last couple of years of federal budgets, the ATO has received much greater funding for its compliance obligations. So of course they're putting a lot of resources, human resources and technology in auditing tax returns. And of course, with data flows and data matching, AI, all these sorts of things, it's a lot easier for them now to identify what they would regard as higher risk tax returns, send out a letter and create a lot of work for us accountants and the client, and a bit of stress probably for the clients. Each year, the ATO talks about where it's focusing its compliance activities on. And this year, they've talked about work-related expenses, rental property income and tax deductions, capital gains tax, cryptocurrency transactions, and the sharing economy. Just to name a few, there's a couple of other points of focus that really aren't that relevant, I guess, to this podcast. And so what Mena I want to do is just record today's podcast to sort of take you through some of the stuff that we've been seeing and, try and help you understand what happens, what goes on with an ATO audit, but most importantly, how to avoid falling foul to one.
And unfortunately, with these kind of audits, it's even though you could be doing everything right and by the book, you can still be flagged at random. So, it's not something that we're only experiencing at ProSolution, but it's across the whole accounting profession. Tax agents are, there's a big uproar across the tax agent profession as a result of this, as you can expect. Creates a lot more work than what we need at the moment. But when it comes to rental properties, there's two real main key points that the ATO focus on. And the first one is repairs and maintenance. So what the ATO want to see is that there's a clear distinction between what we designate as a repair, so things that are basically just returning an asset to its original state, it's not an improvement, and all that of a capital of expense, so something that we've improved beyond its original state. So then the ATO want us to obviously depreciate it over a number of years of its useful life. Now, they're going very, very hard at this point at the moment. In one of my most recent ATO reviews, I've had an ATO officer basically say that because one of the electrical repairs that was undertaken improved the actual wiring because the house was built in the 1980s and it's gone beyond code, the old code, then it's considered an improvement. So as a result, we needed to depreciate it. Now, I thought it was nonsense, given that we're talking about a couple of wires, but they nevertheless considered it an improvement and asked us to depreciate it. So it's really important that you go into each and every invoice. If you're one of our clients listening now, you will notice that we're asking for a lot more invoices when it comes to repairs and maintenance for rental claims, just so we can do our due diligence and make sure that we're claiming it in the right section.
What can clients do to try and maximise their deductions? I guess if the electrician in that circumstance made their invoices, broad or opaque as possible, might help. I'm not trying to bend the rules or flirt the law, but I guess, if we regard that as a repair, if all it was doing is just returning it to the original sort of state that it or job that it did, which is carry electricity, that's all we wanted to do. We're not actually improving it from our perspective. Of course, we want to get that deduction. Is that what the ATO is going to look at? Yeah,
it's exactly right. The invoice that we were dealing with at the time actually mentioned the code that it currently complies with. So obviously the electrician at that point in time went through a whole lot of detail in the invoice and the work proceedings. And some of that had to do because of the insurance proceedings that were happening at the same time with that repair. So, of course, the electrician would have to, in that circumstance, put more detail than what I would assume they would otherwise not put in an invoice. You know, we usually see a bit of handwritten invoices these days for certain trade invoices.
Yep.
But I would very much, obviously we don't want to skirt the law or anything like that, but just be wary of what is actually put in the invoice so it doesn't just raise attention or inquiries for the sake of it.
Yep. And if they stated something like repaired to return it back to its original functionality, would probably be helpful for us as accountants.
Definitely.
Right? Well, let's talk about interest, Mena, because I mean, interest is one of the biggest tax deductions really investors will have across the board, whether it's property investors or otherwise. And so it's one that we certainly don't want to compromise.
Yeah, of course. And, you know, if you got an email from me recently, you would have noted that there's a lot of taxpayers and their brokers, unfortunately, who set up loans incorrectly. They mix purpose, they draw out equities on the wrong loans to purchase for different investments or assets. And it's a mixed bag of deductibility. And, you know, it's
a nightmare.
Exactly, for lack of a better term. So as a result, this is somewhat of a free kick for the ATO. You know, with the introduction of open banking and the data that the ATO is getting, you know, it doesn't take much for them to, you know, put two and two together to see which clients are actually misusing or misappropriating their deductions. You know, it could be things such as a client using a redraw instead of an offset. You know, that's a big difference when it comes to tax. So obviously, when you have excess funds, we always recommend clients use offset funds rather than redraw funds, because if you use your redraw, you're considered to have paid down the loan and you lose your interest deductibility. So we always recommend clients use the offset. We always recommend clients that have a clear purpose for each and every loan, and a good broker would know how to set these up. And unfortunately, I've seen brokers in the past many times, you know, mix purpose of various loans and cross-secure them, and they just make a shambles of it. And the ATO loves that.
I know you're not picking on brokers, but I've seen or heard about, third hand clients receiving advice from even bankers to say, oh no, you can just draw that out of your home loan. They're going to go and buy an investment property, for example. I'll just redraw out of your home loan to do that. So, you know, across the board, the only people you should be taking tax advice from are registered tax agents. So there's a lot of well-meaning people out there that might think they're telling you the right thing, but they don't know what they don't know. And so it's really important. Don't forget, the onus of proof is on the taxpayer. So the ATO doesn't have to disprove the deduction. The onus is actually on you to prove the deduction. Now, if you can't prove the deduction to the satisfaction of the ATO, bang, easy, decline. There's no tax deduction, right? So there's a strong burden of proof, therefore, on the taxpayer to be able to sit down and say, here are all my loans. These are the transactions that I've conducted over the course of the last 12 months or the financial year we're talking about. And we should have proof on how these transactions relate to you earning assessable income. So, you know, if it's just a simple payment of interest in respect to an interest-only investment loan, that's really easy. But as Mena talks about, if there's a redraw or there's some sort of deposit into a loan or a refinance, that all needs to be documented and really clear. So when the ATO comes to us and says, how do you know that this interest is related to that particular asset? We've got all the documents related to that. Okay, the next focus is on work-related expenses. Now, throughout the COVID period, they were pretty aimable. I don't know if you could even use that word when talking about the ATO, but you know, they were pretty easygoing through the COVID period, particularly around deductions from work from home. But of course, now that the government debt's a bit higher and there's a bit of pressure on tax revenue, they want to claw some of that back. So they've been tightening up some of those rules around working from home, and there's kind of two methods that you can use. You can claim the direct costs associated with working from home and come up with all your own evidence in terms of electricity bills and apportioning things and making it really difficult. Typically, we wouldn't recommend that approach. The alternate approach is just claiming a cents per hour, flat cents per hour. Now, you still need to prove how many hours you've been working from home. So again, the onus of proof is on the taxpayer. So the ATO would be looking for spreadsheets, diary entries, these sorts of things. Now, of course, if you work from home on a regular basis, let's say you work from home Mondays and you're in the office for the other 4 days, that's kind of easy. Of course, you need to take into account, you know, if there's any Mondays that you either didn't work or you actually went into the office. But if it's more sporadic than that, not as consistent as that, I should say, then you've got to keep some sort of diary or record to record how many hours. And essentially you can claim 67 cents per hour, and that sort of covers, things like internet usage, mobile, electricity, stationery, all those sorts of things. But the key thing here is just making sure when our clients do want to include a tax deduction for this expense, making sure they've got the requisite proof to demonstrate, how many hours that they're going to claim.
And finally, the last thing that the ATO is probably sort of reviewing and got their eyes set on is sort of around property construction, CGT, and especially those around sort of private wealthy or high net worth family groups. So, they're looking at things such as misclassification of properties, whether, claiming property on capital account to obtain the 50% CGT discount, where the property should be on revenue account, for example, where you don't get the discount, you get the GST credits, but you also got to claim GST on the sale. So they're particularly looking at a lot of developments and, given that, a lot of the baby boomers, for example, are sitting on larger blocks and doing dual occupancies or multi-unit sites, although they're not developers as such, but they've still got the intent to basically build and sell right from, after construction, then they're most likely going to be caught on revenue account. Whereas, they could be getting misguided advice, for example, and trying to sort of get the CGT discount on that disposal, which they won't be entitled to. So obviously the ATO is getting data from the SRO these days, so their data matching is there. It's quite easy for them to obtain. They're also sort of focusing on emitting of income on the disposal of rental properties. Now, even if you dispose of your principal place of residence, you actually still need to report that in your tax return. Now, even though it's exempt from tax, you still need to flag it in your tax return and use the appropriate exemption label in the tax return. They're looking at things such as your BAS returns for property sales, how that matches up to the actual data that's received by the SRO, your GST withholding statements. It's really, a lot of it's got to do with how your record keeping around these property sales and your intention, how you've established your intention prior to any build or sale of a property. Now, as Stuart mentioned, the onus of proof is on you. So when you come to do a development, or it could be a single dwelling, or it could be your family home, or whatever it is, having notes to your broker, from, 5-10 years ago about your intention for the property, trying to establish the fact that it was going to be a long-term property, but there was a change of use because of X, Y, and Z. It's really important to have all these records in place. And, when it comes to property records, in my experience, they're the hardest thing to sort of gather when it comes to sort of establishing your cost base, your intention and so forth. We've got one at the moment that was, I think it was, 1987, Stuart? Mm-hmm. That we're trying to gather the documents for. And of course, between that time and now, there's been a lot of accountants, and the records have been, from one place to another, and some have gone missing. So, it's really important, given that you generally hold property for a long period of time, to keep accurate records. With the introduction of cloud and so forth, it's quite easy for you to do so, as well as your accountant can help you keep records of your cost base as well.
You weren't even born in 1987.
I was not.
Yeah. Okay, so there you go, guys. Look, the ATO's on the warpath. I don't think it's going to change anytime soon. In the recent budget last week, the government forecasts that our debt will exceed $1 trillion next financial year. So they're going to have to raise tax revenue, particularly if they're going to continue to spend like they are. So I think this is our new normal. As Mena said, so I think there's 4 ways we can attack it as taxpayers. Like Mena said, is record keeping. Making sure the invoice is worded correctly, keep all the records. If you're entering into a transaction, like Mena said, you in 30 years' time, you might be looking back, asking yourself for proof of what you were thinking today when you entered in that transaction. So good record keeping's key. 2, get good advice, right? There's advice out there that might be the advice that you want to hear, but what the advice you really want is the correct advice. So it's easy to tell a client, yeah, it's fine, let's just claim it and see how we go. But of course, that could be a much higher risk approach. To our mind, you want to know what is the right advice here, what is the right treatment. 3, you want to make sure that your tax return and tax matters are filed correctly with the ATO. Make sure everything is under the right label. Now, this is a little bit sort of jargonish or technical, but it's about, making sure that your tax return doesn't look unusual. That's probably the best way to put it. And a good accountant will know how to do that, which just means really just reporting the right information in the right spots. And fourth, lastly, you want to make sure that you're going to get the right support post-lodgement. So if you are unlucky enough to be flagged for an audit or inquiry, you want to make sure that your accountant's well versed in dealing with that matter as quick as possible without too much trouble. But we wanted to record the podcast because it's something that we've noticed over the last couple of months. It's a big issue. And probably the final thing to think about or to throw out there is audit insurance, particularly if you have if your tax affairs are quite complex. If you've got really simple tax affairs, you still might like it for your own peace of mind. But certainly if you've got complex tax affairs, what you can do is get an insurance policy that will insure against the costs associated with an ATO audit, which can be considerable, again, depending on the nature and the complexity of it. There could be legal advice, taxation advice, all those sorts of things. So that's something to speak to your accountant about if you're really concerned about that risk. All right, we'll leave it there for today, and until next week, bye for now.